Hi everyone. So today we're going to be looking at depreciation. We're going to start off pretty easy. We're going to be looking at straight line depreciation, but this is a pretty big topic and it's really important that you understand what you're doing and the definitions of the things that you're working with so that it does make a bit more sense. So let's jump straight into the slideshow and get this underway. So, as I said, today we're looking at straight line depreciation. And the first thing that we really need to consider is, what is depreciation? So depreciation, its official definition is the allocation of the cost of a non-current asset over its effective working life. And what does this mean? Well, this essentially means that the cost of the asset that you buy, as you use it up, you're using up its value. With a car, if you pay $50,000 for a car, you can't expect that car to be always valued at $50,000. So as a result, we have to figure out a way that we can fairly represent the using up of this asset, or just the using up of its value. Okay? So we do this to write off part of the cost of an asset against the revenue that it actually earns, because we have to understand that as we use these assets and we use up its value, it is generating revenue for us, but it needs to be balanced out with the expense of using up an asset. Okay? So therefore, depreciation is an important expense. Okay? So we have depreciation as an expense, and it needs to be considered under accrual accounting, because otherwise we're not matching our revenues and expenses properly. So when we're talking about straight line depreciation, we're talking about a method of depreciation where we particularly apply this to assets that have a consistent ability to earn revenue over its life. Okay? Now, what I mean by that is the amount of revenue that this asset earns is going to be consistent no matter what. With a car, that might not always be the case. Cars will start to break down more often as they get older and things like that. Computers will slow down, but maybe your office furniture or the shelving that you have inside a store, that's going to consistently earn revenue for you until it's done. Okay? So in recognition of this, straight line depreciation allocates that cost of the asset consistently at a constant rate over the life of the asset. As I said, office furniture is a really good example of a asset that is used up consistently. Straight line depreciation can be used for any asset, but as I said, we try to apply it only to assets that have that consistent revenue earning potential. The formula that we use to calculate the depreciation expense per year looks like this, where we have the cost minus the residual value, or the value that we think the asset will still have at the end of its life, and we divide that by its estimated life. Okay? Now, you can tell just from the language that I've been using that this calculation uses a few estimates. Okay? They're best guesses at the residual value, and their best guesses at the estimated life. It could be that an asset gets used up faster than we plan it for it to be. It could be that it lasts a lot longer. And it could also be that this residual value, we can't get it at the end. We might be trying to sell an old desk for $100, but maybe there's no market for it. So it is a best guess. So let's look at the following example to see how this works. So if we purchase an office desk on the 1st of July for $1,400 plus GST, and we'll estimate that it has a useful life of 4 years and a residual value of $200. So using this formula, we work out the following expense. We have $1,400 because you've got to remember that GST isn't included in the actual asset. It's its own separate liability. Okay, so $1,400 minus $200 divided by 4 years, okay? Which means we're going to be expensing $300 per year. This brings us to the following adjusting entry that we're going to be making every single year, okay? So when we look at the general journal, you'll see that we are increasing the expense that is depreciation of office furniture, and we are crediting an account called accumulated depreciation of office furniture. Now, this, much like our allowance for doubtful debts, is a negative asset, okay? So it's going to appear on our balance sheet, and it's going to be reducing the value of the asset office furniture. So because depreciation of office furniture is an expense account, you'll see that at the end of the year, we close it off to our P&L summary, and it's reducing the net profit of the business. Whereas our accumulated depreciation, being a negative asset, is going to appear like this at the end of 1 year. We'll close these accounts off year after year as we do that adjusting entry, and you'll see that the depreciation is always closed off to our balance sheet. But you'll see that our negative asset is going to accumulate, and you can see the balance of that increasing year on year on year. So, as I said, accumulated depreciation of an asset is a negative asset that is going to be reducing the value of all our non-current assets on the balance sheet. So, using the example of the office furniture that we purchased and that $300 per year of depreciation, you can see the carrying value is being reduced year after year after year, going from $1,100 down to $800, down to $500, down to $200. Okay? Now, depreciation is an asset that, using the formula I showed you, is going to give you a full year's worth of depreciation. But what happens if your balance day at the end of your period isn't a full year from when you purchased it? There's going to be a lot of times where we need to calculate partial years of depreciation, and we just do that by taking the portion of the year that was where the asset was owned. So say, for example, we purchased our asset on the 1st of January, where that would mean that we have exactly 6 months of use before the balance day. If we purchased it on the 1st of March, we'd have 3 months. So we need to make sure that we're always using the correct dates so that we're not putting the wrong amounts into our depreciation accounts. So a pretty easy way to calculate a partial year's worth of depreciation is just to divide the amount that we first found by 12. So in this case, we have $25 per month of depreciation, and we can then multiply it by the number of months. If you need to be more specific, you can actually divide it by 365 and then multiply it by the number of days if you need it. Okay? So let's jump out of the slideshow. I'll discuss a little bit more about balance day adjustments, and I'll leave you guys with the wrap up. For accountants at the end of the reporting period, it's always a busy time. We are going to have to make a lot of adjustments. It's where we see a lot of our bad debts being written off and things like that. And it's where we make adjustments for all our accumulated depreciation and things like that. As a result, this area of accounting is known as balance day adjustments. So as a result, we need to make sure that our balance day adjustments, our full list of transactions that we need to complete on balance day, really show us a faithful representation of the business. So long as you follow the steps of properly ensuring that you're using the correct amount of depreciation in partial years, and making sure that you're closing off your depreciation to P&L summary, and you're closing off your accumulated depreciation, or you're at least balancing it out, and calculating your carrying value, you should be just fine. So make sure you got your notes ready, and I'll see you guys in class. Have a great night. Bye.